Hi guys, today we're looking at Leggett and Platt, ticker symbol LEG, using my 7 steps. Let's have a quick look at the stock price over the last year and a half. You can see pre-pandemic it was around about $51 a share, then hit lows of $22 a share in March, which would be an excellent time to buy, and has rebounded very strongly, almost hitting its previous pandemic levels at $50 a share, but is now hovering around 46. Now let's look at my 7 steps. Step number 1 is the P ratio less than the market, and Leggett and Platt's current P ratio is 25.58 and the market is 40, so that is a resounding pass. Now we want to have a look and compare it against the sector, and the sector of Leggett and Platt is consumer cyclical, and that has a very low P ratio of 24.97, so that is a fail, though it is very close. And then, does it pass the bonus step less than the historical average? And the historical average of the market is 17.5, and obviously it does not, so I'm not going to give it an extra check mark there. Just before I continue with my next step, can you please leave a like on the video? It really helps me out, and in return I'll keep giving you guys more quality stocks that you can buy. Next is the revenue increasing. And the revenue has gone from 3.9 billion in 2017 to 4.28 billion, so that is a pass. The revenue is increasing. Next step is the profit increasing, and the profit has actually gone from 292 million to 247 million, so that is actually a fail. The profit has decreased. Fifth step are the shares outstanding decreasing, and you want this because if you own 10 shares of a company and there are 100 shares outstanding, you own 10% of a company. Then if the company buys back 50 shares, there are only 50 shares outstanding, therefore you would own 20% of that company at that point with 10 shares. So it really rewards investors if they're buying back their shares, and Leggett and Platt are buying back their shares. Not much, it's gone from 136 million to 135.7 million, but they are buying back their shares, not issuing new ones, so that's good. Now we want to see if their current assets can pay off their current liabilities, and this is a yes. They have 1.6 billion in current assets and just over 1 billion in current liabilities, so this is a pass. Can I give them a bonus mark here? Is the current assets greater than the total liabilities? And the answer is no, but they can pay around 50%, so that is good news, but not enough for an extra check. And finally, is the free cash flow increasing since 2017? And the answer is a resounding yes. Very good here, gone from 284 million to 536 million, so that is a pass. And why I like the free cash flow increasing so much is because the companies can use it to pay dividends, which is definitely something we'll discuss here with Leggett and Platt. They can repurchase shares, which they have been doing. They can pay down their debt, and they can reinvest in the company. So an increasing free cash flow helps me provide a valuation and does those other things as well. So it's, as I said, it's almost doubled, so that's great news. So out of my 7 steps, that is 5 out of the 7 core steps, which is great. No bonus marks, but these are very good numbers. P ratio and the profit are the only two that failed, but free cash flow is increasing and the P ratio is very good compared to the market, so these are very good passes. Now I want to look at the free cash flow yield and ratio, and to get this I divide the enterprise value by the free cash flow or vice versa, and the enterprise value is the market cap minus cash and cash equivalents plus total debt. So Leggett and Platt currently has an enterprise value of 7.7 billion, and with that free cash flow of 536 million, that gives a free cash flow yield of a whopping almost 7% and a free cash flow ratio of just over 14. So these are excellent numbers. So one thing that people like about Leggett and Platt is its large dividend. It has an annual dividend of $1.60, which is a dividend yield of 3.42%, which is a massive. It is a safe dividend if you look at it here, 60 to 70% based on the estimates, but for free cash flow, which is what they're using, that'll be 36%. So this dividend is not going anywhere. And it has a dividend track record of 50 years growth, making it a dividend king. That is excellent. The ex-dividend date was on the 12th of March and they'll be paid out in April 15th. So if you buy your shares now, you won't get the next dividend, but then you'll be eligible for the dividend that normally is paid in July. So buy the shares now if you want to get the dividend in July. But this is a massive dividend yield, great annual dividend, and very safe based on the free cash flow. So just looking at some analyst estimates here, and on Simply Wall Street, they have it with a fair value of $50 a share, which currently means it's 8% undervalued, so Simply Wall Street says it's a buy. Normally I'd be looking at tip ranks here, but they only have 2 analyst ratings as a moderate buy, with actually a fair value of $40 a share, which is 14% downside. I just think analysts haven't really got too many ratings on this. I would expect a lot higher for a company of this size and this quality, so I just think the data here on tip ranks is not really updated. If we quickly look at Yahoo, the recommended trends have it at a hold and a buy and a strong buy, so bullish on there, and has a rating of 2.5, which puts it bang in the middle between buy and hold. So it looks like it is a buy according to Yahoo. And if we look at the price targets, you can see they have it at an average of $46.75, which is just around the current price, and a high side of $52 a share. So the analysts are saying it's a buy for Yahoo. Now onto my valuations of Leggett and Platt. I use a discounted free cash flow model here and then a buffer Graham intrinsic value, and as you can see I've calculated the future cash flows, and that has gave me a calculated stock price of $70 a share, which means it's currently at a 50% discount. So discounted free cash flow says it is a buy, and this is with slightly more reserved numbers. 2019 and 2020 were over 500 million. I've gone a little bit more reserved, saying that they won't hit 500 million free cash flow until 2024, and that still says the stock is undervalued by 50%. And looking at buffer Graham intrinsic value based on the earnings per share and the growth rate, this has a fair value of $58 a share, which is a 23% discount, but a Graham price of $43 a share. Now this Graham price, don't be too worried, is if you want to buy the stock at this price and hold for 20 years, this Graham price would say that you'd have no worries whatsoever. So hoping for a little bit of a pullback to buy it at this Graham price, but with the fair value you can see it's $58 a share, which is currently at a 23% discount. So both models are definitely saying it is a buy. So looking at the technicals of Leggett and Platt, I have the price with the candlesticks, a 50-day in blue and a 200-day in gold. So looking more recently, the bullish signals would be the price crossing in August. As you can see, the price crossed the shorter day moving average, so that would have been a buy signal. And then there was a golden cross in September, which would signify that that is a buy signal. As you can see, the shorter day moving average crossed the 200-day. Looking a bit more recently, you can see the price has fluctuated around the 50-day and has then crossed it massively, but now it looks like the 50-day is providing a little bit of support there, so it's not breaking through, and the 200-day is still nowhere near the price. So we haven't even come close to the 200-day yet, which would be around $42 a share, and it looks like it's going to bounce back up again. So the technicals here saying it's a buy off the moving averages. So I've added a parallel channel here which shows the last 6 months, and you can see it's traded pretty comfortably within this line. It looks like it is going to be increasing again, could hit around $49 a share in the short term, but if it gets as low as 42, that would be a definite buy because it has not broke this channel in quite a while. You can see this channel has held up until around July 20, which was still in the throes of the pandemic as the stock was increasing. So it looks like this channel is holding. So if it gets to anywhere between $42 a share, that is a massive buy. And if it hits around $50 a share, that would be a sell signal to take your profits, wait for it to decrease again, and then buy it on the upswing. So definitely some good signals here. Right guys, I want to thank you all for watching. Please leave a like if you've enjoyed the video and give a comment on your thoughts on Leggett and Platt, and consider subscribing if you want more stock analysis videos, and I'll catch you guys next time.